welcome to the deep dive.
Hi there.
This is where we take that pile of sources you send us, articles, research notes, whatever you've got, and we really dig in.
Yeah, we pull out the key insights, the stuff that surprises you, and basically cut through all that noise.
Think of it as your shortcut to getting genuinely up to speed.
And today we're diving deep into the sources you provided on Innodata Inc. That's ticker symbol INOD.
And you gave us some really detailed stuff, reports, analyses, covering their business, financials, market view, the whole 9 yards.
So our mission for this deep dive is to unpack all of that, pinpoint what's critical, and understand what really matters about Innodata, but, based only on the material you shared.
Okay, let's get into it. Because right away, some of those numbers in the sources just jump off the page.
Oh, yeah. Like what?
Like recent revenue growth, up 120% year over year.
Yeah.
In the first quarter of 2025. That's massive.
Wow, 120%. And didn't we see something like 96% for the full year 2024 too? Exactly. Great popping stuff. We absolutely have to figure out what's driving that and, if it's sustainable.
But here's where it gets really interesting, I think. As we go through this, keep in mind, alongside that explosive growth, your sources also lay out some pretty significant legal questions and a lot of market volatility around the stock.
Right. Definitely need to touch on those risks. And by the end, we promise we'll leave you with a thought-provoking question that kind of ties all these different threads together.
Oh, and a quick plug. If you're enjoying these deep dives, and maybe you want your request prioritized, Stock Analytics AI members at the Euro 4-month 99 a month tier can give us a ticker symbol, and we'll prioritize getting their deep dive analysis done sooner.
Good to know. And just a reminder, all the sources we're talking about, we've linked them in the description below.
Okay, let's jump in. First half, the core business, the fundamentals.
So Chapter 1. What does Innodata actually do?
Okay, so fundamentally, they're a global data engineering company.
Data engineering, meaning they help big companies deal with messy data. Your sources describe this hybrid model they use.
Hybrid.
Yeah, it combines their own AI tech. They have a platform called Golden Gate with a really large, skilled global workforce.
How large are we talking?
Over 5, maybe even 6,000 experts. A lot of them are based in Asia, Philippines, India, Sri Lanka, that kind of region.
Okay, so AI plus thousands of people. Why that specific mix?
Well, the core job is turning complex, raw, unstructured data, think messy documents, images, whatever, into usable, structured digital information. Stuff enterprises can actually feed into their systems or AI models.
All right.
So the typical workflow, according to your sources, is they get the raw data, process it with their AI tools, but then crucially, there's often human review involved, especially for quality control and the tricky stuff. That human-in-the-loop thing seems key to their quality claims.
Got it. That makes sense for complex data. So how do they make money from this?
Primarily through 3 business segments mentioned in the material you sent. The biggest one, by far, is Digital Data Solutions, DDS. That was bringing in around 78% of total revenue towards the end of 2024.
78%. So that's the main engine.
Absolutely. And it's growing fast. This part does the AI data prep, collecting it, creating it, annotating it for training AI models, plus deploying those models and general data engineering support.
And this is where that crazy growth is coming from.
Your sources definitely point to DDS as the primary growth engine, especially because they've expanded their work with, quote, big tech clients. That seems to be the fuel for the recent fire.
Okay, DDS is the growth story. Who else?
Next up is Synodex. That's smaller, about 12% of revenue. Stable growth trend there.
What's Synodex focused on?
It's more specialized. Think insurance carriers, healthcare providers, legal firms. It takes unstructured stuff like medical records, turns it into usable digital formats, offers API integration. They've got maybe a dozen customers, including some big U.S. and global life insurers.
Interesting niche. And the last piece.
That's Agility. Roughly 10% of revenue. And the trend there is stable to maybe slightly decreasing.
What does Agility do?
It's basically an industry platform for marketing and PR folks. Helps them target media, send out content, monitor news, and social media. Serves about 1,500 customers.
Okay, so a mix of services. How do they charge for all this?
Right.
Project fees, subscriptions.
It sounds like a mix based on your sources. Project-based fees for specific data jobs, definitely. Subscription fees for platforms like Agility. And maybe some usage-based pricing tied to how much data they handle or how complex it is.
Let's go a bit deeper on the products. Beyond the services, what core tech or platforms do they have?
Right, so besides that core AI data prep and engineering support, the sources really emphasize their proprietary AI platforms.
Like Golden Gate.
Exactly. Golden Gate is highlighted as central, described as a low-code AI stack supposedly deeply trained over 6 years, state-of-the-art for like 50-plus different knowledge tasks. It seems to be their foundational tech.
I don't know.
They also have specific platforms for LLM and machine learning annotation, document intelligence, a medical data platform for Synodex, plus stuff for regulatory change management and media intelligence for agility. They even still do some ebook services and custom data capture.
So they're not just throwing people at the problem, they're building tech to scale and specialize.
That's the picture painted, yeah. The sources suggest a strategic move towards these higher value services and platforms like Synodex and agility, trying to climb the value chain, build more recurring revenue streams.
Makes sense. So how big are they really in the grand scheme of things? Where do they fit in the market?
Right now, they're a small cap global company, market cap floating around, say, $1.16 to $1.2 billion as of May 2025.
Small cap, but they've been around a while, you said.
Over 35 years, yeah. So they've got history.
Yeah.
And they leverage that huge global workforce, over 5,000 people, across more than 20 delivery centers worldwide.
Who are their typical customers?
It's diverse: publishers, media, retail, banks, insurance, government. But there's a major strategic focus now on big tech. Specifically, the company's building and adopting large language models, the LLMs.
And get this, your sources explicitly state they count 5 of the Magnificent 7 tech companies among their customers.
5 out of 7. Okay, that is a big deal. That's some serious validation.
It really is. Now, in the broader AI data solutions market, they estimate their share is maybe only 1–2%. So they're not huge overall.
But they're trying to differentiate, right?
Exactly. Through that specialized expertise, their tech, the hybrid model. And that global structure helps them scale, operate 24/7, handle like over 85 languages.
So what's the core pitch? Why do these huge tech companies choose them? What's the value proposition?
The main idea is empowering clients with data and AI to make better decisions. They apparently aspire to be the preferred tech partner for data quality, scale, and agility, especially in generative AI.
Building on that long history and focus on quality data.
Precisely. Key selling points seem to be providing that high-quality data essential for training good AI, the blend of AI plus human oversight, their own tech like Golden Gate, and that cost-effective, scalable global workforce. Plus, those established relationships build trust.
So they're positioning themselves as like the infrastructure providers for the AI gold rush.
That's exactly the analogy your sources use, the picks and shovels in generative AI, providing the essential stuff, data services, no matter which specific AI models end up winning. That legacy, that focus on quality, and the trust they've built with major clients are presented as key differentiators.
Okay, stepping back, what are the big market trends fueling this? Because that 120% growth doesn't just happen in a vacuum.
Oh, they are definitely riding some massive waves. The sources talk about surging AI adoption overall, like 18% plus annual growth.
But generative AI specifically is exploding.
Exploding is the word. Maybe 75% plus CAGR for Gen AI services. Enterprises are moving past just experimenting. And there's this huge growing demand for high-quality training data.
Because garbage in, garbage out with AI models.
Exactly. The AI data annotation market alone, your sources project it going from maybe $2 billion this year to $10 billion by 2033. That's like 25% growth per year.
Wow.
Plus, you've got trends like AI reasoning, agentic AI stuff that aligns with what Innodata offers. And maybe the biggest driver, hyperscaler spending.
The big cloud providers.
Yeah, Amazon, Microsoft, Alphabet, planning to invest over $250 billion in capital expenditures in 2025 alone. And guess what?
They're Innodata's key clients.
Bingo. So the companies using Innodata services the most are pouring unprecedented amounts of money into the very infrastructure that needs those data services. It's a direct demand catalyst.
That seems like a pretty powerful tailwind. Your sources even mention an analogy about untapped data potential.
Yeah, like comparing the data process so far to a dime,
Right.
while the potential is a whole football field, just illustrating the vast opportunity they see.
Okay, huge opportunity. But who are they actually competing against in this space? Must be crowded.
It is. Very diverse competition, according to your sources. You've got specialized annotation firms, think Appen, Scale AI, TELUS International. They're direct competitors on the data labeling side.
And then the guys.
Yep, the huge IT services and BPO companies, Accenture, Cognizant, Infosys, IBM. They all offer data and AI services too.
So how does Innodata differentiate itself from them?
They pitch themselves as offering more full-service data engineering, not just annotation. They claim advantages like that hybrid model, the Golden Gate platform, their scalable global workforce, deep domain expertise, medical, legal, all those languages and those critical established client relationships.
Right, the Magnificent Seven connection.
Exactly. The CEO even reportedly noted that their largest direct competitor was valued at something like $25 billion, highlighting the massive valuations in this sector.
So they're not trying to compete just on size or lowest cost?
Seems not. The strategy described is carving out a niche based on handling complex, high-quality data engineering, especially for those really demanding AI and LLM clients, like the big tech firms, who need customized quality, competing on value and complexity, not just price alone.
Makes sense. What about regulation? Does that play a role here?
It definitely does. The sources describe the regulatory landscape for AI and data privacy as complex, constantly changing, and different all over the world.
Like GDPR in Europe, CCPA in California.
Right. Those directly impact how they have to handle data for annotation. Requires secure processes, compliance certifications, plus there's growing focus on ethical AI, data sovereignty, especially in North America. It's a minefield.
How does Innodata navigate that according to the sources?
They acknowledge the risks in their official filings, naturally, and they emphasize compliance. They actually position offering secure and compliant annotation services as a potential advantage.
Turning a requirement into a selling point.
Kinda, yeah. But being global means they constantly have to juggle all these different, sometimes conflicting rules.
Any other external risks mentioned, like global trade stuff?
There was a note about potential indirect risk from U.S. tariffs, particularly if they targeted Chinese tech or software. That could potentially affect the industry, maybe client costs, and indirectly dampen demand.
But management didn't seem too worried short term.
Reportedly, management downplayed the immediate impact on their prospects, but the sources still flagged it as a potential broader industry risk factor to be aware of.
Okay. How hard is it for someone new to just jump into this market and do what Innodata does? What are the barriers to entry?
Your sources suggest they're moderate to high.
Right.
Scaling up manual annotation. Expensive. Finding enough specialized talent. Hard. There's a shortage. Keeping data quality high across massive projects. Challenging.
It's less building the tech.
Right. Developing sophisticated platforms like Golden Gate takes serious R&D investment. Building the scalable infrastructure costs money. And then there's trust.
Gaining client trust, especially with those big tech companies, must take time.
Exactly. That's a barrier. And just handling data security, meeting all those compliance rules we talked about, it's not easy.
So what's the really hard to copy part? The secret sauce.
The sources suggest it's the combination of things. There are 35+ years of experience handling complex data. Their proprietary tech, that huge, skilled global workforce integrated into the hybrid model, and crucially, those established trust-based relationships with the big tech players. Building that whole ecosystem for quality delivery at scale, that's tough to replicate quickly.
And you mentioned talent scarcity as a risk because they rely on that workforce.
Yeah, exactly. Because finding and keeping those skilled people is hard. It could lead to wage inflation, impacting their costs. It's a double-edged sword.
Okay, so let's wrap up this first part. What's the bottom line on the business understanding?
Innodata is playing in a booming AI market with huge tailwinds. They've got some unique assets. The hybrid model, tech, key clients, creating real barriers for competitors. But the market is crowded. Regulation is a headache. And while their model is hard to copy perfectly, others are definitely competing. It's a dynamic space.
All right, that sets the stage really well. Now let's talk about the people steering the ship. Chapter 2, Management Evaluation.
Okay, leadership. The sources point first to the CEO, Jack Abuhoff. He's a co-founder, been there a long time.
And he's credited with this big AI pivot, right?
Yeah, guiding that strategic shift. And honestly, you look at those recent results, 96% growth in 24, 120% in Q1 25, and landing 5 of the Magnificent 7. Operationally, that suggests the pivot under his leadership is working, really working.
So strong execution on the strategy front. But didn't the sources immediately bring up some major red flags too?
They did. And this is crucial. Right alongside the operational success, the sources highlight this ongoing securities class action lawsuit filed back in Feb 2024.
And related investigation.
Yeah, SEC and DOJ investigations started last year, too. And it all stems from allegations that the company misrepresented its AI capabilities, specifically tied to something called the Wolfpack Report.
Misrepresenting AI capabilities. That cuts right to the core of their current business narrative.
It really does. The sources also just briefly note the interim CFO, Marissa Espinelli, has been interim since March 2022. Just something to note regarding stability in that specific role.
Okay, so the biggest crisis facing them is this legal storm questioning their AI claims. How are they responding publicly, based on the sources?
Well, the company's official stance, cited in your sources from their filings, is pretty standard lawyer speak. They intend to vigorously defend themselves against the lawsuit. They're cooperating with the SEC and DOJ.
I'm surprised there.
Right. They also acknowledge they can't predict the outcome, and yeah, an unfavorable result could have a material adverse impact. Beyond that formal stuff, the sources don't really detail any broader public counter-narrative or specific actions to maybe reassure investors outside the legal process.
Interesting. What about transparency overall? Do the sources paint them as an open book?
They follow standard procedures, press releases, earnings calls, SEC filings. They use non-GAAP metrics like adjusted EBITDA, claiming it adds transparency.
But there's always a but.
But the lawsuit specifically alleges misrepresentation and also a lack of disclosure about R&D spending during the class period. Your sources mentioned that R&D costs often seem bundled into broader expense lines in their financials, making it harder to track clearly.
So formal transparency mechanisms exist, but the core allegations challenge whether they were actually transparent, especially about R&D and AI capabilities.
Exactly. Although the sources do note that more recent management commentary seems a bit more candid about operational risks, like that customer concentration issue. So maybe a slight shift. Hard to say.
And their ethical reputation, beyond the legal allegations.
They have the formal structures, a code of business conduct, audit committee procedures for complaints. But yeah, their reputation is clearly under scrutiny because of those lawsuit and investigation allegations about misrepresenting their AI. The sources basically say the outcome of the legal stuff is key to how people will perceive their ethics, especially since their mission talks about enabling ethical AI.
Okay, so summing up management, what's the takeaway?
Based on your sources, management has demonstrably driven significant strategic change and impressive recent growth. They've landed huge clients, that's clear. However, their historical honesty and transparency are under a serious legal cloud right now. And that creates a big question mark around leadership trustworthiness, doesn't it?
It certainly does. That's a critical duality. Okay, let's shift from the people to the numbers. Chapter 3, financial health. What did the sources tell us?
All right, the financials. Based on your data up to mid-2025, Q1 results. It really shows a company transformation. Market cap around $1.2 billion, so small cap.
And valuation, high, low?
Pretty elevated. PE ratio, depending on how you calculate it, somewhere in the 30s or 40s TTM. Price to book around 15 to 18. That definitely suggests the market is pricing in a lot of future growth.
Which connects back to that explosive revenue growth we talked about. How does that look on the income statement?
It looks dramatic. Q1 2025 revenue up 120% year over year, full year 2024 up 96%, and management reaffirmed guidance for 40% plus growth for 2025.
Wow. And profits, are they actually making money with all this growth?
They are now, and margins are improving. Gross margin is solid, like 43%.
Yeah.
Operating margin around 14%, net margin 17% recently. Though the FY24 figure got a little boost from a tax item, it points to increasing operational leverage, revenue growing faster than costs.
Okay, strong growth, improving margins. What about the balance sheet? Debt, cash.
The balance sheet looks quite healthy, actually. Very little debt. Debt-to-equity ratio is low, like 0.1 to 0.13.
So not leveraged up?
Not at all. They had about $56.6 million in cash at the end of Q1 2025. Way more cash than debt. Plus, they have an undrawn $30 million credit line giving them flexibility. Seems like prudent debt management.
Okay, so if we summarize financial health, currently profitable, yes. Strong balance sheet, yes. Yeah. Low debt, yes.
But earnings consistency, not really. Historically, they had net losses in 2022 and 2023 before this very sharp turnaround. So the consistency of this recent profitability still needs to be proven long term.
And didn't we mention a risk related to that profitability?
Yeah, that customer concentration. One customer being 48% of revenue in 2024.
Yeah.
That definitely adds potential volatility to future earnings, even if things are looking great right now.
Good point. Okay, that covers the core business, management, and financials. Let's move into the second half, external factors, market view, risks.
Right. Starting with Chapter 4. Market sentiment. How's the market feeling about Innodata?
It's definitely mixed based on your sources. There's clear optimism on one side,
Driven by.
that high growth, obviously. Their direct link to the AI boom, being mentioned by firms like Wedbush and AI Reports, the NVIDIA collaboration, that stuff gets attention, and you see it reflected in generally bullish analyst ratings.
Okay, that's the bull case. What's making people cautious?
Several things. The high valuation itself, the stock's priced for a lot of success, making some nervous. Then there's the significant stock volatility.
How volatile are we talking?
Its beta is apparently 2.75. That means it moves, on average, almost 3 times as much as the overall market, up or down. So, big swings.
Okay, that's high.
Plus, those legal uncertainties we discussed definitely weigh on sentiment. And importantly, there's notable short interest, people betting against the stock. And it's trading well below its 52-week high.
Tell me more about those analyst price targets. You said generally bullish.
Yeah, the consensus among the 5 analysts cited is buy. The median target price is around $52.20, with some going as high as $75 or even more. So implying potentially substantial upside from where it was trading, around $36.
But there's a wide range in those targets, isn't there? Like $24 up to almost $79?
Exactly. That wide range really shows how differently analysts are weighing the growth potential versus the risks. But the trend mentioned was upward revisions, which leans bullish.
How did the stock react to recent news? Like that huge Q1 earnings beat. Did it soar?
That's where the mixed picture really shows up. Q1 earnings were a beat, great numbers operationally, but the stock reaction, volatile. Your sources even noted it dropped significantly in aftermarket trading right after the beat.
Huh. So good news doesn't always equal a rising price here.
Apparently not consistently. Other news, like attending investor conferences or that NVIDIA collaboration, provides positive visibility and validation. But that underlying volatility seems to be a constant theme.
You mentioned short interest being notable. What are the numbers there? And what about options traders?
Right, the short interest. Around 14% of the float was short as of late May. That's significant. It means a decent chunk of the market is skeptical or hedging bets. It would take shorts over 4 days of average trading volume to cover, which is quite high.
So real skepticism out there. What about options?
Interestingly, the put-call ratio cited from late April was low, suggesting options traders at that specific time were leaning more bullish. But the high implied volatility in the options market, around 79–80%, confirms everyone expects big price swings.
Okay, putting it all together.
Yeah.
What's the takeaway on market sentiment?
The market is clearly excited by the AI growth story. You see it in analyst targets, some options activity, but there's a really strong countercurrent of caution. High short interest, extreme volatility, sometimes negative reactions even to good news. It shows the market is really grappling with how to price the potential against those significant risks.
Makes sense. Let's look inside the company now. Chapter 5, ownership structure. Who actually owns INOD stock?
Okay, ownership. A good chunk, around 37.5%, according to your sources, is held by big institutional investors. Think BlackRock, Vanguard, Morgan Stanley.
So the big money managers are involved. Is that good? Bad?
Generally seen as a positive sign. It means professional investors who do a lot of due diligence see something compelling. But it also means their buying or selling can really move the needle on the stock price.
What about insiders? Management? The board? Do they have skin in the game?
They do. Significant insider ownership, reported around 15.6% to maybe 18.2%. That usually helps align their interests with shareholders, which is good.
Usually good, but...
But your sources highlight a specific trend recently over the last 3 to 12 months. Insiders have predominantly been net sellers of the stock.
Selling more than buying.
Considerably more, yeah.
Right.
Over 2.1 million net shares sold in 12 months. Over 300,000 in the last 3 months alone, based on the data cited. There are specific examples of directors and the interim CFO selling, often after exercising options. The CEO's holding also reportedly decreased last fall.
Okay, so institutions hold a fair bit. Insiders have significant ownership, but have been net sellers lately. What does that tell us?
Well, insider selling can happen for many reasons. Diversification, personal finances. It's not automatically a negative signal.
But given the context.
Given the context of the ongoing legal allegations, which apparently include claims about insider selling after promotional activities, that pattern of recent net selling noted in your sources, it definitely warrants closer scrutiny by investors. It's another piece of the puzzle to consider.
Absolutely. Okay, let's pull all the risks together now. Chapter 6, risk assessment. synthesizing the challenges mentioned across the sources.
Right. So pulling it all together, beyond the standard stuff like intense competition, which we discussed, they face both specialists and giant BPOs. Several key risks really stand out from your material.
Like the regulatory environment.
Definitely. That complex, evolving global landscape for AI and data privacy, constantly needing to navigate different rules like GDPR, CCPA, various U.S. state laws. Failure there is risky, and that potential indirect risk from trade tariffs is also lingering as a broader industry factor.
And the barriers to entry, while good for Innodata, you mentioned risks tied to their workforce.
Yeah, exactly. While the barriers are substantial, the market is competitive, so others are finding ways in. And Innodata's reliance on that large, skilled global workforce makes them vulnerable to talent shortages and wage inflation, which could squeeze their margins or limit growth.
Okay, what else? There was a big one operationally.
Customer concentration. Huge risk flagged in your sources. One customer accounting for 48% of revenue in 2024. That's massive dependence.
Meaning if that client pulls back or changes strategy.
It could have a major impact on Innodata's revenue and earnings. Very volatile potential there. Management even specifically acknowledged potential quarter-to-quarter swings tied to this largest client.
And then the elephant in the room.
The legal and investigation risk. Yeah. That ongoing securities class action lawsuit, the SEC and DOJ investigations into whether they misrepresented their AI capabilities. Your sources frame this as the most significant external risk.
Because the outcome is unknown.
Unknown and potentially materially adverse, according to their own disclosures cited. It creates this constant overhang of legal uncertainty, potential damage to reputation and trust, potential fines or other consequences. It's a big cloud.
And finally, the valuation and volatility itself is a risk.
Absolutely. That high valuation means expectations are sky high. If they fail to meet those expectations for any reason, operational slip-up, client loss, fallout from legal issues, the stock price could fall sharply. And that's amplified by the already high volatility, that 2.75 beta. Okay, so boiling it down. The main risks beyond normal competition based on these sources are really the legal challenges, the customer concentration, and the risks tied to that high valuation and volatility.
Got it. All right, Chapter 7. Conclusion. Let's wrap this up and reveal that hook.
Okay, so we've done our deep dive into Innodata, based purely on the sources you provided. And what we've seen is a company that's successfully pivoted hard into this booming AI data engineering market.
Achieving truly remarkable recent revenue growth.
Phenomenal growth, yeah. Driven by that hybrid AI-human model, their proprietary tech like Golden Gate, and landing these critical relationships with big tech clients. They've built a strong balance sheet. They're profitable now after past struggles. Operationally, it's impressive recently. However, this picture of rapid growth comes with significant counterweights. The market's super competitive, regulations are complex and ever-changing, the stock is incredibly volatile with a demanding valuation, and there's notable skepticism shown by that short interest.
And critically,
the company is under the serious legal and regulatory microscope regarding allegations they misrepresented their core AI capabilities. The outcome? Uncertain, but potentially very significant.
So let's reveal the hook. That initial point that grabbed us, the 120% revenue growth, boasting about magnificent 7 clients.
It's absolutely validated by your sources. They are achieving that incredible growth. They're working with top tech companies. That part checks out. But the sources make it equally clear that this growth story isn't happening in a vacuum. It exists within this complex web of sky-high market expectations, acknowledged operational risks like that heavy customer concentration, and this significant legal cloud that could really impact investor confidence in the company's future trajectory.
Which brings us to that important question we wanted to leave you with.
Yeah. Given the undeniable operational success lately and those powerful AI market tailwinds boosting them, how should you, as someone looking at this, weigh that potential for continued rapid growth?
Against the very real risks that are clearly laid out in these sources, particularly that uncertainty swirling around the legal issues and what it means for market sentiment and future volatility.
That's really the core tension here, something for you to mull over.
And that is our deep dive into Innodata Inc., based entirely on the comprehensive sources you shared with us.
Yeah.
Seriously, thank you for providing such detailed material. It really allowed us to dig in.
Yeah, great sources. And hey, if you have another topic you're curious about, another company, and you've got sources you want us to explore, definitely send them our way.
And if you happen to be watching this on YouTube, please make sure you subscribe to the Stock Analytics AI channel. You don't want to miss future deep dives like this one.
Finally, just the standard but important reminder. This deep dive was created using the specific sources you provided, and we used AI to help process and synthesize them.
It's purely for informational purposes based on that material. It is absolutely not financial advice.
Nope. Always, always do your own thorough research before making any investment decisions.